One of the things I wanted to share with you early on is I was reading about, I was lucky enough to get some pre-IPO shares in Alibaba, and then I was reading a Fortune article about Jerry Yang and his investment in Alibaba, and then it mentioned in there something that Masayoshi Son, who is the CEO of SoftBank, one of the largest Japanese technology companies, they also made a very early $20 million bet in Alibaba that is now something worth about, I don't know, $30 billion, right? From 20 million to 30 billion, something ridiculous. But I have the secret to fundraising for all you entrepreneurs in the crowd today. And Masayoshi Son, he said that he invested in Jack Ma because of an animal smell that he had. So don't shower is the key to raising money. All right, so let's get to this. I have something to share with you. Is this not working? Or? Oh, okay, yeah, other way around. All right, so let's take a look at some charts first. It's actually very, very timely and important for our discussion today. This is a chart of the NASDAQ stock market. You'll see that in the last few weeks, it's dropped almost 10%. Likewise, across the water here, you see London dropping well over 10%. This is also happening in Germany, something like around 12% there. The next chart shows an outlier. China's up, but that's only because they've been struggling for the since 2012, right? So they're not playing the same game that we're playing in the developed world. And then here's Norway. I guess this is a good proxy, the Dow Jones Norway Stock Index. I'm sure you guys have a better index to go by, but that was the only one available to me. And that's gone well off, and there are implications for this, and I'll get to that. But a little about my background. I was part of a small group of undergraduates that launched a $20 million venture fund between our sophomore and junior years in university. And that sounds ridiculous, and we got very lucky, but we were able to do that. We raised $20 million. We made 15 investments, and 4 of those have become IPOs, and all in different verticals: enterprise software, telecommunications hardware, biotech, and the latest one, Control 4, is in home automation. So 4 very, very disparate industries. And then I spent a little time with a private equity fund in Utah, of all places. I chased a blonde-haired, green-eyed girl who comes from Danish and Norwegian and Danish Andersons to Utah, which is the big Mormon school. And I grew up in Chinatown, San Francisco, so you can imagine what my great, what the culture shock was. And yeah, so no alcohol, no smoking, no drinking. And then I left that to co-found a technology company called MediaForge. We were one of the early pioneers in advertising retargeting. We weren't solving great problems like Saul was encouraging us to do, but we got acquired by Rakuten, which is a rival to SoftBank. And then in 2009, when the market and the world was in the dumps, I didn't want to do anything. So I spent a year fetching tea for a guy named Seth Godin. Some of you may know him. He's one of the premier, one of the top thinkers of marketing. And then I returned to San Francisco to start a company called LaunchHear. It was part of the Y Combinator Winter 2010 batch. And what I discovered was that I'm not very good at building technology with $30,000. I need at least $2.5 million to start. Let's see. So then quickly, after I shut down LaunchHear was actually successful in the sense that it was profitable, but it wasn't scalable. So I created a couple of incubators. Topline was my first one. And here's a snapshot of Topline before we started filling it up. It's never this empty anymore. And here's a snapshot of my newest project called Topline, and this is the event space in Topline. Topline is really big. So just a little background on these guys. Runway was opened in January 2013. It measures about 30,000 square feet or almost 3,000 square meters. There are currently 85 startups at Runway, and they've raised a cumulative total of $125 million. Some of the top investors in the world love to come to Runway to pick off their favorite investments. Google Ventures, Sequoia, they've all been to Runway to make investments. And since January, this is the stat that I'm most proud of. There have been 6 exits, averaging about 40 to 45 million each. The latest buyer was Cisco. And so when you think about it, in a year and approximately 9 months, we've seen close to $250 million of exits that we've been able to help nurture. And that's unprecedented speed. And I'm very proud of that fact, but there's also a reason why it's also the reason why I decided to do top line. But it's also something that could happen here at Startup Lab. I took a walk around. Carl and Tor and Alex gave me the walkthrough of the space, and I feel like Startup Lab has the ingredients to see results this large, And so then let me move on to Top Line. Top Line is actually bigger than Runway, 4,000 square feet. What's different about it, it's probably the first and only one that I know of where half of our square footage looks like a call center full of people that don't shower, right? We have... really what it is just a marketing and sales center, right? So the other half looks just like Startup Lab or Runway, a lot of open collaborative space. And then the other half is just revenue. It's just revenue capture. And there's a systematic way to think about that. And it'll be germane to what we're talking about a little later. Some of the early teams that came in since just June, so only a few months ago, have seen their revenue growth up 200 to 300%. And what makes Topline different is that we invest in the companies, and then we really get active in helping them scale. So not only do we provide mentorship and advice and help them connect with investors, but we get into the operational details of scaling. So one thing I found in my experience at Runway was that there are a lot of teams in Silicon Valley that are good at building product. There's a difference between building product and building a business, right? And the business part sometimes seems like more boring, right? Seems more process-oriented, more repeating every day the same thing. And it turns out that's what scaling is. That's a very major part of scaling. So I'll give you a couple examples of what we've invested in and helped to scale. This is unconventional. You wouldn't think of this as a startup incubators, one of our first investments. So this is a consumer packaged good, right? This is the world's first 100% fully biodegradable diaper. But this will scale. And I hope that it solves a big problem, one of these big problems that Saul encouraged us to solve. American landfills, I think there was a number, 20% of landfills are diapers, and traditional diapers don't disappear. They're made with petroleum products, and they last for nearly forever. So this is the first one with fully organic, materials. So this will disappear in a while. Probably between 2 to 3 years after usage. And I love the name Poof. Pandora Bots is another company at Topline. It's artificial intelligence as a service, and I think that's very exciting. So any developer with a product where you want AI in your product can plug in and then develop AI without having to do it yourself. There have been over 250,000 chatbots developed. What's interesting about this AI is that all these developers will put in their own artificial intelligence technology or parameters or content, and each robot in the network will learn from each other. And so you could have, it just gets smarter and smarter. And this is a very big idea that we're very excited about. Going back to why I decided to create an incubator where half of our square footage is devoted to scale is because 5 out of those 6 exits at Runway I felt were premature. right? It's very, and that's a very big problem in Silicon Valley. I don't know if that's a big problem here in Scandinavia, but when you have an offer on the table from Cisco for around $45 million, it's hard to say no. And while we all know that incubators are becoming a big trend in startup world, right? You see incubators popping up everywhere, here in Oslo, but you see them in France. I have good friends that are starting incubators in Barcelona, in Shanghai, everywhere. Incubators, for the most part, will be built for helping teams get started, get conceptualized, maybe launch a product in alpha or beta. And then what happens is if you're creating great technology, someone will come around to say, we better acquire that, make it a talent acquisition, or get that off the market before it becomes too big. And one potential problem in the future as incubators become bigger and bigger is that it will sort of encourage startup founders to exit too soon, because that's just the environment. Oh, this is a great place to play, and it's good for small teams, but it's hard to scale up and hire a marketing and sales staff of over 50, for example. So I wanted to create more space for that. All right, so that's us. Back to those charts from before, especially this chart of Norway. This is very important, right? And then here for us in the United States, the NASDAQ and the S&P 500 are the two important charts for us to look at. In the past, when there have been market dislocations, it's resulted in a reduction of venture capital, because at least in the United States, most of our VC dollars come from large pension funds that allocate 1 or 2 or 3% of their entire portfolio to venture. It's a risk asset class, and most of it is invested in the stock market and fixed income. And so when the stock market starts to fall, then the availability of venture capital starts to fall. And in the United States, our market cycles last, our bull cycles last between 3 to 5 years. So since 2009, we haven't really had a serious bear market. So we're due for one, right? So this is, at least from my standpoint in the United States, sobering times. It could lead to, if we have a long-term correction, it could lead to a huge reduction in venture. And, that happened during the dot-com bubble and bust. It happened in the recession in 2008, 2009. So what's next? Why are we seeing this? Is the market telling us something different? And in the United States, we're trying to solve this problem about with the way venture is so tied to the general market. And so here's something that I've been noticing. At least in the United States, we have something. What we're trying to work on is what I call the great decoupling. Right? We just don't want to be so tied to the public stock market. And so in the United States, we have something called the Jobs Act. It's legislation that's working its way through Congress. And if it does, you're going to see a lot of crowdfunding. We already have some very, very successful crowdfunding platforms like Kickstarter and Indiegogo. They're not equity-based, however. But if certain portions of the Jobs Act get passed, we're going to see a lot of equity crowdfunding. And it's going to usher in a whole new environment for the United States and Silicon Valley. And we'll have the opportunity to once again be on the cutting edge of how we start companies and how we finance companies. And I asked Carl yesterday about whether this has been a large movement in Norway, and the answer from Carl was no. But you guys should think about that a little bit. Some of these other platforms like WeFunder, Funders Club, and AngelList, we're going to see a massive amount of funding flowing into technology startups that are not tied to the public stock market, not tied to pension funds, and that's really exciting, and there's a double-edged sword to that. Let me talk about what will happen. So there will be a barbell effect, and we're actually seeing this already, right, with angels. So on the left side of the barbell, you have a lot of large incubators like Startup Lab or like Topline or Runway, helping startups get started, helping them get funded, helping them to get into the next institutional round of funding, getting their first customers, getting their first partnerships, getting them distribution to the market. You have accelerators like Y Combinator, where I learned a lot from Paul Graham about how to foster companies and how to get them to scale. You'll get super angels, and then and then the next part of this left side of the barbell will be the crowd in the United States, and then on the far right side, right, of the barbell, you'll have just mega funds, like the largest venture capital funds. For us, that would be Andreessen Horowitz or Sequoia, Excel, and then you see hedge funds and private equity entering this market too, which was alluded to earlier by Sean Randolph from Bay Area Council. We're seeing a lot of early stage, seed stage funding, right? Just a ton of it happening, and then in the middle where you have medium-sized venture capital funds, those are disappearing, right? Or they're going to be very few. They will be vertically focused maybe, but there's no room for the generalist middle-sized venture fund. And then you have these huge mega funds, which so we're seeing a lot of activity in the United States where you have a idea stage, seed stage startup getting funded for 50K, 100K, and that's happening in the thousands, right? The count is hard to even keep up with. And then you have what's turning into massive A rounds. I've never seen numbers like this before, and I just picked three off the top of my head. These three are all, and the full screen is actually consumer, so you can't say it's just on the enterprise side, but you have companies in their A round of funding all being funded over $30 million. I mean, that would probably be like a D round here, right? It's just insane. But actually for me, very rational, because we've figured out how to start fast. We've figured out how to find product market fit very quickly. And so A rounds are all about now just winning the green fields, right? Just taking market share. Just it's a land grab. So you might as well spend as much money as possible to get the land grab, to win the land grab. And so to me, this is very, very rational. A lot of people will say, "Oh, the numbers look insane," but all the risk has shifted up front to angel investors and incubators to help get to proof of concept and product market fit, and then you see this like massive Series A. So, when Anna and Carl invited me to come talk about the new investor landscape, this is what we're seeing. So back to that chart for Norway right here, where we've seen, what is it? That's a massive decline already, right? And what it's telling us, I think, from my outsider's point of view, is that oil is in a short-term bear market, right? And the Norwegian economy being so tied to oil and gas prices, you're seeing that reflected in your overall stock market, right? And what that could lead to is some economic volatility for you guys, but it also means that there's an opportunity to transition and to diversify a little bit. And I've always felt like, wow, this is an amazing opportunity. When I've had conversations with Anna and Osa, a good friend in the Innovation Norway program, I always figured, wow, if you could have a really stable and intelligent political and socio-political environment where you have an abundance of a natural resource, and you could take that and reinvest it into innovation and technology, that's just a dream come true. And then I learned yesterday that the United States will soon surpass Saudi Arabia as the largest producer of energy. And I say, we couldn't. It's almost unfair, right? But now Saul talked about leapfrogs, and I completely agree with him. One of the things that we've done well in the United States is that we've nurtured a angel network. I think there are angels in Norway, right? Obviously there are, and in the United States we have I think we have a much deeper social mesh of angels, right? They meet regularly, they have meetup groups, and they come together a lot to look at deals. I think organizations like Startup Lab can play an important role in developing angel networks, right? And where angels are coming together to look at deals together. And then, if there are surpluses in from the natural resources in Norway, you really should, the country should think about reinvesting those in emerging managers of venture capital, of hunters of innovation. I think in the United States we have acknowledged that there's this concept called peak oil, and I don't know if Norway's onto that, but obviously it would be a prudent investment in the future. And then one of the things I wanted to talk about, and Saul alluded to this too, how do we build and scale together? And half of what I do at Topline is to help domestic startups grow. The other half, and I'm working with Jetro, which is kind of the Japanese equivalent of Innovation Norway, and also a group in Australia where we're taking very successful companies from startups from Japan, from Australia, and then they get a soft landing at Topline where they're not doing innovation at Topline. They're just doing capturing market share and capturing revenue and capturing customer base. And so one of the things that I think will form in the next 2 to 3 years is that a tighter connection between incubators in lots of different countries. And the reason for this is actually we can really blame the Germans and the Chinese for this, right? In Germany, we have the Samwer brothers, right? And in China, we have just an army of anonymous developers who are really good at copying, and the Samwer brothers are really, really, really good at copying, right? So the first victim of this was Groupon, right? So you remember when Groupon started to scale and become this massive phenomenon, and then all of a sudden you saw the Samwer brothers building clones of Groupon in Germany, but they also did that in Hong Kong, they did that in Singapore, they did that everywhere. And when Groupon had to gear up for an IPO, they were forced to make a decision between building their own global outposts or buying them. And for a lot of the times, they decided to buy from the Samwer brothers, right? And so now the Samwer brothers have developed this methodology of copying, right? They're even better than the Chinese at it. They're even better than the Japanese at it. And so then, the Chinese have gotten really good at it too. So what we're seeing in the United States is this phenomenon of startups that have gotten traction being forced to go global much earlier in their lifespan, in their life cycle, right? Uber is going global in its, third year or fourth year, right? It didn't used to be this way. Going global was a 10th year decision or an 8th year decision or beyond that, right? So now it's becoming a 3rd year decision or 4th year decision, right? You're seeing that. And I think one of the safest ways to go global is through a network of incubators, right? So if a startup has traction in the United States and wanted to enter Europe, Startup Lab would be a great place, right, to go global, to at least enter the European market. And the other way around, if a startup at Startup Lab were to scale, how do they enter the United States market? They would go through an incubator in the United States. I think allocating resources to help startups go global will be very important because you're going to have to do it faster. Now, this is not a skill. that Silicon Valley has in abundance, right? Going global is not a skill that we have in abundance. I think that the companies the companies and cultures that have proven that their ability to go global are companies and located in Japan, like Fujitsu and Sony. They've gone global. They've proven that they can play the global game. And here in Europe, it's Siemens or Nokia, right? They've proven that they can go global. This is not something that Silicon Valley is very, very good at. And we're having to learn that on the fly. And then last slide is just a word I want to leave you with is courage. This risk-taking mentality that we have in Silicon Valley. As we go deeper and deeper into crowdfunding, you'll see the widows and orphans of America get more brave and more courageous and join at least participate in the startup environment through funding. They may not be our source of talent, but they'll be participating alongside the super angels, the incubators, and the VCs and the pension funds in funding innovation in Silicon Valley. So I think that's where I'll leave it. And I wanted to raise more questions than answers for the next panel. So thank you very much for your time.